All right, everyone, time for another big top down view. There's a lot of narratives going on in this market, and I want to briefly touch on all of them. Then I want to give an update on the macro, the broad market, go over the SPX indice, and then we'll kind of give some projections and possibilities. And I want to try to cover all these things in the most neutral way possible. I'll give you the bull case and then the bear case, and then you can decide. And then I'll talk about the path that I think. So start. I do want to just briefly say that this is a tough market. It's a very tough market. And as we've said over and over and over, probably for the past few weeks, but I will say again because it is an important reminder, markets like this, this is not where you try to be bold and get big plays and, go all in. This is where you kind of lay up the gas. Survival is your greatest edge. In the words of Charlie Munger that we wrote in the newsletter recently, making a ton of money is not about making the next genius move. It's about avoiding the next mistake. And I think at MBT, we have slowly grinded out returns out of this market when it comes to trading. And that's fine because honestly, not losing money would be okay for me. Tough time periods like this are transitional. Granted, it's gone longer than I expected, but they do usually give way to solid trends that are much easier to play. So at this moment, all you want to be doing is looking to just survive this, and if you've been sitting in cash and not touching anything because it's a tough market, that is perfectly fine. Okay. You should only act when you have the confidence to act, and keeping smaller size. So with that said, let's talk about the shutdown. On Friday, there was a rally into the close. Market had to turn off the bottom. There was a lot of speculation that this was related to a vote on whether to fund federal employees. There was a lot of noise on Twitter about it being to end the shutdown, but neither of those things happened. The government still shut down for the longest shutdown in history, and on top of that, they did not pass an extension of fees to pay government employees. So this shutdown has now persisted long enough that it's going to also cause problems with data collection. And we've even heard some Fed governors come out and say that this is doing more damage to the economy and the market than they expected. So that's something to consider. That might be a point on the board for further rate cuts in December as well. But it should be noted that we think that rate cuts on December should be considered guaranteed. And if they do not happen, we expect the market to have an aggressive downturn, if not an outright crash. We think that the Fed should be cutting here faster than they are based on the weakness that we're seeing in the consumer. This market's been all about the Magnificent Seven stocks, and it has done a astounding job of ignoring the forgotten 493. So which show us lots and lots of weakness. Go read that last newsletter. I won't pound the table on that too much. So then there's the idea of the AI bubble. And lots of people are worried about this AI bubble. And honestly, I could combine AI bubble with AI debt, right? So that you can see the companies that are taking on the biggest debt commitments are getting beaten down the most during this time period. Oracle just also saw outfunding more funding on Friday and got approved for it. Another $16 billion in debt. And there's lots of concerns that these companies will not be able to pay off this debt. The bears say this is too much. There's not enough support for it. And these companies are overspending. It's going to be a drag on their future earnings because of all of this. Now, to that end, people are worried about Meta putting some of their debt off their balance sheet using creative financing that I'm not going to cover in detail, but there's the bears are worried about it because it's similar to what Enron did before Enron blew up. If you aren't familiar, Enron was, a very large company that blew up during the '08 crisis, and it took a lot of people off guard. It's important to note that when I say it took a lot of people off guard, that are, even the anticipation of the collapse of the housing crisis or the fact that .com was a bubble, a lot of these narratives get changed and recreated by people on social media. But the reality is that Wall Street typically knows about all these things well beforehand. Okay, the idea that no one knows what will cause a crash. I think that idea needs to be wiped from your mind, because someone always knows. And in the age of access, the democratization of information, there is no reason not to be aware of all the risks on the table, because the likelihood someone knows is 100%. Someone always knows, and there's probably someone pounding the table about what's going to cause the next crash. And it could be any number of the things that we've been talking about here. So that AI bubble really centers around that debt at this time period, because especially now that some of these stocks have taken big dumps, the evaluations within the Magnificent Seven aren't really that big. And even some companies on the peripherals, whether we're talking about some of these quantum names, they've come down substantially. IonQ is definitely still overvalued here. It's not as asinine as it was before. Or we talk about speculative companies like Oklo. Yes, this company is still definitely overvalued, but it's not as what the heck is going on type of evaluation now. It has come down a bit. Even some head over skis when it comes to nuclear has come down a bit as well. We're talking about the gold rally. It's taken a nice relaxation, right? Some things are coming back down to levels that are high, that are expensive. But if we're talking about what a bubble can do, can have more room to run, for sure. So it's important to kind of keep a mild take on that. Understand that the bubble narrative, it gets weaker the more this falls. Okay, the more this falls, the weaker the bubble case is, because evaluations have come debt. The way the construction of the debt is right now, bears, I told you the bear case. The bull case is that a lot of this debt has flexibility based on the income that the companies make. So that flexibility actually gives them breathing room if there is a collapse in demand from AI. And we also heard some comments from Sam Altman over at OpenAI that the company's making a significant amount of money. There's a lot of speculation on the number. I've heard anything from 20 billion to projections to make 100 billion in revenue, which would put them near NVIDIA numbers for income. So where this is we obviously don't know for sure. We can't verify that information right now. There's insiders who do know that information, but so far all I'm going off of is reports I'm hearing. That range though is still really good money. That said, that companies made massive commitments to that debt, but there is in the debt structure, from what I've seen so far, room for a sort of down draw and demand that will pay people off. And also, one of the things that I was thinking about during this time period is I just tried to play the hypothetical in my mind of, okay, let's say I hit some financial troubles. I'm a trader, who runs my own trading business. Let's say there's a brutal market crash. And everyone's like, well, this service is pointless because the market's, the .com bubble's blown up and my business fails, and I don't keep track of the risks, and I fail as well. What do I cut? Would I cut my OpenAI subscription, my Grok subscription? Would I no longer use Gemini? And I think that I would cut my services before I did that. I think I would cut my Netflix, my Angel Studios subscription before I did that. I think the AI subscriptions might be just because it helps me be so productive. It helps me organize my thoughts. It's been an amazing tool to check my bias. Before I make any of these videos, before I make any newsletter, I tell AI to try and poke holes in it. that is too useful of a tool for me because it's a non-biased actor that I can bounce ideas off of. And I know it's finicky. Sometimes it doesn't get things right. But honestly, the people who say AI is useless are not using it. And I can tell you, someone who's used it a bit and who's very critical of these things, that it is extremely useful. It just is. And I don't cut that subscription. So the idea that demand would suddenly fall off a cliff, I'm actually not a big believer in. However, I do think that, the market is in a bit of a bubble still because there were plenty of companies that were doing well that had demand and great paths forward during the dot-com era that still collapsed. So that is still something to keep in mind. So let's talk about the repo market now. So we've had before I do that, let me describe what the repo market is. The repo market is I'm going to give a simple definition. It is the banks, the Federal Reserve providing liquidity to the banks, so providing them overnight emergency liquidity so that banks can fulfill their commitments. That money gets paid back to the Federal Reserve, and there are concerns about spikes in the repo market. However, if you do historical analysis, the spikes aren't yet concerning. Nor, as Jerome Powell said, do they seem systemic now. So, and actually, as of right now, I agree with that opinion. There were some private companies blowing up because of some debt obligations. You might see more of that. But honestly, I still think, as of now, things seem fine on that end. And then we'll talk about government and investments. This is the bottom of the list because it is the not the biggest concern from the market, although people do wonder if the government goes underwater in all these investments, or they worry about the government picking winners. If you're not familiar with what I'm talking about right now, I'm talking about the government investment and investments in the rare metals, MP being the standout name there, or investments in like the foundries, which are the chip creators, like Intel. The bear case here is that the government shouldn't be picking winners and causing distortions in free markets. And that is a more socialist practice. And even though there's historical precedents of the government doing that in World War II and it turned out fine, that this can lead to further issues in the future. The bull case for it is the government is creating a sovereign wealth fund, and that can benefit the tax payer by giving them direct access and investment into the most key companies and U.S. infrastructure, being the rare metal providers and the chip makers, right? And that should be something that people are excited about, that the government is directly backing them and getting prepared to win the AI race, which, at this point in time, just last week, we heard Jensen Yang say that he thought that China was right behind us and likely to win the AI race. Now, whether he said that because he truly believed that, or whether he said that to try and put pressure on the government, a lot of these representatives in the government do not understand AI. When you hear them talk about technology in general, they still don't even know how Facebook works, how cell phones work. To think that they would understand the all the necessary components to creating AI infrastructure, it's highly unlikely. So that comment, though, could be a flame that is meant to ignite a sense of urgency. And that's the way I kind of view that. I don't know if he truly believes that China's going to win, but China has had great new models come out. Their Cursor model, their Kimi models are doing very well, and they're ahead of us when it comes to any energy infrastructure. So, and that is right now what lots of people are saying is the true constraint, the bottleneck on the AI race for the U.S. So, and he believes, Jensen believes that China will catch up on chips, and that us not selling chips to them so that we can make more money and put that back into AI infrastructure is a major mistake. So I don't really have a strong opinion on that. Two, I'll just add that is the bull and bear case there. Hopefully, you feel like those are well balanced takes on all those narratives, and you could kind of make up your mind. Now I'm gonna go through the macro. Okay, so let's kind of the technical here. So you might remember about 2 months ago we talked about 67.51 being the top for the market. We were within a percent of that, and then we did get a dip that we were looking for. The market ended up reversing out of the hole. And many people were saying, okay, now it's all sunshine and rainbows. November to March is the strongest time period. However, if you've been reading the newsletter or you've been following me, I still expected us to kind of roll right over. We've still stayed short, thinking that valuations are too hot. This rally is too big. We're not satisfied with the 3% dip. And so we ended up being at this point within about 3% of the high. Let's see, 2.7% within what we think is now a major high. I think now is this is where I think we had the big potential to puke. And we can see here on the chart, we've both broke the bullish wedge here, and we've broken this support that was formed after that first dump that we got, right? So now we are also testing the daily EMA here on the SPX. Now on Friday, we ended up defending it, launching out of the hole. However, even into the after hours, we can see how much that flattened out, which does make me think, was that any institutional buying, or was that retail pumping it up? Regardless, I think this is where you can kind of look for some fib retracements. We did close some puts on Friday, but I kept some on. And we can also see here we're pretty far extended from our bearish EMA, right? A revisit back up to this, retesting the bottom of this wedge, would be classic bearish price action. And I think it is far too soon to say that the bottom has formed. If we look at the top AI names like Palantir, we can see, okay, we're back testing this trend line. So if we dump on Monday, and keep in mind that our momentum indicators are showing that the RSI has come down a lot from Palantir. It's been weak. If we look here on the weekly, it's been in a downtrend actually since December of 2024. There's been no momentum confirmations all the way up for Palantir. Additionally, we can see that the TTM is rolling over on the week, the 2-day, and the 1-day. So this is kind of like the AI star child. This is the and earnings, and it's doing this, by the way, with earnings still being great. However, earnings needs to continue to be great for another 50 years for this valuation to be grown into. So keep in mind how still insane these numbers truly are. Additionally, people don't like comments made by Alex Karp as well, and by Sam Altman. I guess I'll interrupt myself real quick to kind of talk about those as well, because that's been a pretty major story when it comes to the AI bubble. Okay. Alex Karp and Sam Altman both have been aggressive in their defense of critics, saying that AI isn't in a bubble. Alex Karp is a very politically motivated person who's not afraid to share his conservative political beliefs. And he has taken a lot of flack for doing that. And so I think he receives a disproportionate amount of tax because of that. And that's more politically motivated than actually motivated by the state of the company. I think the big takeaway there is he's participating in a political debate, but at the same, he's participating in a political debate. His company is obviously doing extremely well, but the valuation is obviously extremely high, which could be normal for high growth companies, that people are willing to pay an insane premium. But with that comes insane risk. So if this company just only slightly beats earnings at some point in the future, especially as their earnings expectations continue to climb and climb and climb and climb, there is some point where you're going to hit that cliff, or there's going to be some point now where they get caught up in the market pulling back, an exhaustion of buyers from poor liquidity. The consumer is not doing well. when we look at the performance in Bitcoin, there was a tweet I saw from a major crypto influencer, over 200,000 followers, who said, "I'm not selling my Bitcoin, but I also have no money to buy." And to me, that just feels like that's got to be all. That's probably reflective of almost everyone in crypto, based on the data that I'm seeing right now. And then there's the Sam Altman interview. And then right after our poor interview where he said, well, if people want to sell their shares, I can find a buyer, which people didn't like. If you know me, I'm all about talk that talk. If you can walk that walk. And so honestly, I could be a bit of an abrasive person, and I didn't see a problem with him saying that. But they're very sensitive people who thought that that was him getting overly defensive. I think they nitpicked it too much. I didn't think it was a big deal. But right after that, then he made a request from the government for investment into OpenAI and to guarantee some of their debts. And people did not like that at all. They made an argument that AI is a vital part of infrastructure. And I think that argument sucks. Sorry, OpenAI, you might be the leaders right now, but we got Grok, we got Gemini, we've got Perplexity, we've got Anthropic, there is actually a lot of healthy competition within AI. On the surface level. Granted, on the back end, Microsoft's pretty much controlling everything. Microsoft, Google pretty much got their hands on it in every pot. But as far as the public is concerned, to the government, it's a very healthy battle of competition here. So people aren't really worried about that. All right, anyways, let's shift back. Now that I think we've covered all the narratives, back to the macro here. Okay, so as I said, some retracements here on these time frames back to the bearish EMAs or all the way back to the support is pretty normal. So I've cut some puts, but I am looking for a further extension to the downside. And one of the ways you would try to measure out what might be some levels is, one, you can use those EMAs. A lot of technical people will use something like the Fibonacci's to say, okay, a 50% retrace it would take us to 67.76, which is like right. Looks like it's just about to break out of this EMA convergence that's formed here. So maybe you'll see something like that form. Now, when you do these sharp rallies during a greater downtrend, so this might be the sharp rally, but the downtrend right now is lower. You know, we're seeing lower high, lower low, lower low, lower low. If we continue to set another lower high, it should happen relatively quick. In bear markets, rallies are sharp and quick-lived. So I think early next week we'll have further clarification on whether we're going to get a continuation to the upside. And honestly, you would look for something as simple as a higher high from this trend. It's very simple. There's no real reason to overcomplicate it. And then you would have to get more cautious about getting short like we did here. You know, we have these massive gap ups. I think the anticipation of buying, I do want to say that I think that the government reopening is pretty much a non-factor and not something that I would be concerned about if for a short thesis. I think the government reopens, the data comes out, and maybe it causes some ease of mind, but I think it's really what we're being faced with is the liquidity crisis shown in Bitcoin. The consumer is hurting, and there's just not a lot of appetite from buyers. It's just buyer exhaustion everywhere, which we've seen, right? We've shorted any company that's gotten pops after earnings, we've shorted, and it's worked. Pretty much across the board. Even Amazon that got that second pop after the open. They had the earnings, they got a big pop, and then they had the OpenAI deal that gave it another pop. People were like, oh, that's going to help AWS, and then they sent it even higher. Okay, well, we took that short post earnings. They squeezed me on the remainder, and I just took a short again and won again on the next pop. Shorting these pops, and here, like now we've defended this bullish EMA on the daily, right? So I'm looking to see over the next few weeks, and pretty much broadly across the market, you'll see that we're defending these EMAs pretty much across the board. So that previous low that we just got, if it breaks, that's when we start looking for a visit, likely down to 6,400 at this point. So 6,550. I could go through here and I could draw some key levels pretty easily. We got a key level there. Let's see. Looks like the bottom here was also another key level. We're seeing lots of tests here. Oh, let me fix this. This bottom. We've got a big key level here. We've got a top here. We've also got some failure to climb over that there. It looks like we've got another one here. It's a bit weaker, so we got to move this actually up here. We've got some tops, and then it became a base that we rallied off of as well. So that's another key level. And then it looks like this one's a key level as well. So if you don't like using fibs and you just want to use simple price action, I think these are the key levels that you should kind of keep an eye on here. This just looks like all chop here. So it looks like this is the next key level here that you should be mindful of. It became a base, and it became a top. Became a point of resistance, then a point of breakout. So yeah, I like these key levels on the downside for us. And then likely then the bear case would be that down here at the lows, the Fed does more cuts, and those cuts don't work, don't save the market, and you get a continuation of the downside. Or the Fed doesn't cut, and you just crash down. That's when we probably get quantitative easing, and we get panic cuts, and they try to bring this market higher. So right now, we think we pull back here, and then we have a continuation to the upside. However, with the exhaustion of buyers, like that behavior, honestly, to play out this thesis needs to change for us to be bullish in the next year. I need to see some momentum confirmations pretty much across the board that right now are non-existent. Especially when we look at Bitcoin, yet another thing where we've come down and we're defending this bullish EMA on the weekly, but on the daily, this price action is as bearish as it gets. And I've been saying that you need to get a move through 116. Pretty much like since October, I've been saying that we need to reclaim 116, and we still have not done it. So from here, I think we're gonna break this trend line that we've held since 2024. Is my base case. I don't think this holds. I think we're going to get a plummet right through it. And that's just part of the liquidity issues that I think are rampant in the market. The bears might feast in November, and then maybe by Christmas, the bulls can have their heyday. But that's what I see right now in the market. So go ahead and leave some comments if you have some comments. Thanks for watching the video. It's a longer one. And subscribe to the free newsletter. Okay. All right. We're going to be releasing our free course soon, as well on the website. So make sure you keep an eye out for that. It's taking longer than anticipated, but it's going to be really, really cool when it's out. So I think you're going to love it. I'm very, 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 very proud of what we've got, and that's why I've delayed it a few times. But I think it's for the right reasons. Just tweaking stuff and making sure it's the absolute best course with just the info you need. So check out the YouTube, by the way. I've got one video out, and after doing this video, I'm going to work on some other ones as well. Some video paired lessons for things that require more visuals. But that's all I got. God bless. Have a great rest of your weekend, guys. And I'll see you all Monday for a live stream.